In November 2020, retail investors gained access to Axie Infinity's governance token, AXS, at a public launch price of 10 cents per token. This compares the public retail entry with the private institutional reality. Months before launch, funds secured 10.8 million tokens at a cost basis of 8 cents. That allocation went to 5 specific entities: Arca, DeFiance Capital, Delphi Digital, Hedge, and 3 Arrows Capital. Securing tokens at 8 cents established a cost basis so low it remained profitable throughout the entire cycle. By the October 2022 unlock, when prices had fallen to $9, these early investors were still holding gains of 11,000%. The ensuing GameFi supercycle was a highly structured institutional arbitrage built on pricing depth, heavily documented on-chain for anyone who knew where to look. Extracting these returns required a strict, replicable, 4-layer quantitative model. When the cycle eventually compressed, the funds that abandoned this framework and overextended themselves faced immediate consequences, with multiple portfolios entering formal insolvency. Courts in the British Virgin Islands ultimately assumed jurisdiction, overseeing the liquidation of these virtual portfolios through appointed restructuring firms. Today, the initial cycle is over, but 3 distinct, mathematically uncorrelated mispricings exist in the market right now. Outperforming the market requires auditing these primary data layers before the generalist allocator crowd recognizes the signals. This chart tracks the first layer of alpha. Delphi Digital invested roughly $60,000. At the token's all-time high, that position was valued at $123.75 million. Expanding the data reveals identical 2062x multiples, pushing DeFiance's allocation to $26.4 million and Arca's to $72.2 million. Delphi Digital achieved exactly this by co-designing the AXS token economics directly with the protocol's developers prior to launch. This architectural role provided them with private foreknowledge of exactly how the token economy would operate, detailing the vesting schedules, supply unlocks, and demand sinks. Layer 1 alpha is derived directly from strictly underwriting these structural design parameters before they become accessible to secondary market buyers. This line chart maps the protocol's revenue growth. Axie Infinity scaled from $100,000 a month in January to $196 million by July. The trend peaked in August, briefly surpassing the entire Ethereum network in rolling 30-day revenue. Specialized fund managers tracked this publicly available on-chain data and rapidly applied traditional equity analytic frameworks to effectively interpret it. Managers applied the same frameworks used to value pre-revenue software equities, identifying the moment the protocol transitioned into a cash flow generating business. Access to real-time on-chain revenue data provided a 90-day information lead over generalist allocators, waiting for traditional financial reporting cycles. The third layer of alpha required strict structural differentiation, specifically when navigating a dual token ecosystem. This divergence chart demonstrates the necessary split: the hard-capped governance token, AXS, versus the infinitely inflationary in-game token, SLP. Because SLP lacked a demand ceiling to absorb its expanding supply, its price continuously degraded, eventually suffering a 99% crash. Dodging that systemic inflation leads directly to Layer 4, vesting calendar arbitrage. In October 2022, a publicly scheduled supply shock released 21.5 million tokens into circulation. On-chain analytics confirmed that Arca utilized this exact calendar data, depositing its entire 437,500 token allocation directly to an exchange immediately upon unlock. Institutional survival dictates preemptively exiting at these specifically documented supply shock events to successfully avoid holding through the subsequent inflation. When managers abandoned these strict data frameworks, the market cycle's compression rapidly consumed their capital. 3 Arrows Capital aggregated digital assets into a portfolio operating under the name Starry Night Capital. In June 2022, a British Virgin Islands court ordered the firm's liquidation, transferring control of the assets to Tino Restructuring. The portfolio had commanded a piece valuation of $35 million. By the time of liquidation, Nansen Analytics valued it at less than $861,000. Conversely, Multicoin Capital documented a 91.4% drawdown in 2022, but by adhering to their core model, logged a 9,281% recovery in the following cycle. The collapse of these major funds was a consequence of traditional cross-collateralized leverage. The analytical frameworks used to identify the gaming alpha remained technically sound. Currently, a completely separate asset class is accumulating yield entirely independent of the broader crypto and equity markets: Counter-Strike 2 skins. This scatterplot matrix maps findings from the Quarterly Journal of Finance, analyzing 4,565 specific assets over 10 years. The data isolates an average annual return of 41.2%, carrying a Sharpe ratio of 0.34, the highest risk-adjusted return profile in the comparison. The non-correlation is visible in the raw data. On August 5, 2024, the Nasdaq dropped 4.77%. The skin market declined just 1.19%. The structural reason for this inefficiency is straightforward. It is a $5 billion market dominated entirely by retail players, with zero institutional quantitative pressure. Systematic alpha relies on identifying and exploiting these exact retail-heavy inefficiencies before institutional frameworks step in and compress the margins. For allocators constrained strictly to public equities, the cleanest traditional vehicle for virtual currency exposure is Roblox. The accounting edge relies on a structural lag. Roblox records virtual currency purchases as deferred revenue, categorizing them as bookings before recognizing them as official GAAP revenue. Bookings grew 63% year-over-year in Q4 and 31% in Q1. Tracking these bookings provides a forward-looking signal weeks before the data hits the income statement. Looking ahead to the next cycle of private token rounds, the managers who built the initial quantitative framework will simply deploy it again. The specific video games and platforms will rotate every cycle. The structural entry points and mathematical realities remain fixed. Financial outperformance is built on modeling the internal mechanics of the virtual economy, an analytical layer that exists independently of the games themselves.